So first, thank you so much for those who are here today. We'll have more joining us momentarily. So thank you for those who join later. And thank you to everyone who watched this after these remarks. Truly appreciate it. So we want to, it's 2024 and we have another election coming. And the economy, as always, I think in election years tends to be in the forefront of everyone's mind. And so I wanted to take time for each and every one of our clients and give you the opportunity to hear from an absolute expert, the head of global market strategy for Goldman Sachs. And if you have been investing for any bit of time at all, you certainly have heard the firm Goldman Sachs and its just incredible legacy, impact, and dominance in the marketplace. So John actually, Tousley has his CFA. If you aren't familiar, that's a chartered financial analyst. It is one of the most difficult degrees to get in our industry. Some say even more difficult than getting your PhD in finance. He has spent, many years with Goldman Sachs and has been a managing director with them since 2011. He lives in Salt Lake City, Utah, with his family, and earned his BA in economics from Brigham Young University. Forgive me, I can talk today, I really can. In 1991. So here's why I really wanted to do this, if I can, setting aside John's incredible background and expertise in work in Goldman, is that I think one of the things that I hear more often from our clients is who are the voices in the room with me on a weekly, daily, monthly basis that I lean on for an eye on what's happening in Wall Street. We can all pick up the Journal and The Economist or turn on CNBC or Fox Business and hear what the talking heads are. But those folks aren't making critical decisions on actual, real, significant dollars. To understand without political bias or an agenda, to hear from somebody who's doing the actual economic research on a day-to-day basis and directing billions of dollars in assets helps us make wiser decisions as individuals. And so I wanted to have John here because John's perspective, his team's perspective, his expertise in years of experience will give each and every one of us who spend time listening to the remarks he has to share with us an opportunity to understand without biases or agenda really what's going on with the economy, how should we thinking about the election, and help prepare us to make wiser choices about our dollars on a going forward basis. So John, thank you so much for investing your time into these important relationships of ours. And I'm looking to hear forward to having this conversation, hearing your wisdom and for our relationships to have your expertise available for the coming 45 minutes.
You bet. Kyle, thank you so much for the kind words. I am honored to be with you and your clients today, and I will do my absolute best to be useful and share some perspective. To do that, I am going to share my screen. I'm a big fan of pictures, and I will go through and talk probably about 15, 20 minutes on the macro landscape and how we expect the economy to perform. And then I'll talk a little bit about markets and also talk a little bit about, as investors, how we should think about elections and what we should do. And more importantly, probably what we shouldn't do as investors when it comes to elections. And then again, obviously, Kyle will ask questions throughout, and we're happy to take as many questions as we can possibly field throughout the day. Also joined by my colleague, Charlie George. He supports Kyle locally, and I'm grateful for him to be also on this call today. All right, let me share my screen. And when Kyle was kind of giving the introduction, he used the word perspective. We actually, I think that's really a perfect way to think about this. And we title our presentation Misperception. Now, it's a little bit of a play on words, but for anyone who has on this call perhaps ever gone to Plymouth Rock, you've probably been, like most people who see Plymouth Rock, a little underwhelmed. It's much smaller. You know, when you're in grade school, you think about it as the Rock at Gibraltar. But what makes Plymouth Rock significant is not its size, but its historical importance. You know, the landing point for the Pilgrims. As I go to the next slide, I want to take that to another example, which is for many of you, you may have been to the Louvre. in France, and the standout, most important work of art in the Louvre is the Mona Lisa. And everybody, as they approach the Mona Lisa, is often underwhelmed by the size of the portrait. It's 22 inches by 33 inches. Again, it's not the size of the portrait that matters, but it is this work of art by the master Da Vinci 700 years ago, where he was able to capture this enigmatic, ambiguous expression. Is the Mona Lisa smiling? Is she mad? Is she sad? Is she mischievous or coy? You can see what you want to see in the Mona Lisa. And that variable of perspective is what makes this such an extraordinary, timeless work of art. Scientists have kind of looked at this and they said, why do some people see a frown and others see a smile? And what they've determined is it's a little bit of perspective. If you are super focused and you look really narrowly at the Mona Lisa's mouth, you have a decent chance, maybe 50-50, of seeing a frown. On the other hand, the more you pull back and you capture facial expressions and the entirety of the portrait, the more you're likely to observe a smile. Now, why do I talk about the Mona Lisa in an economic presentation? I think the same scientific analysis applies to the economy. If you look at very certain indicators, like the inverted yield curve, where short-term rates are higher than long-term rates, or the leading economic indicators, or some measures of consumer confidence and sentiment, you can absolutely see an economic frown. There are absolutely pieces of data that point to, you know, thoughts of recession and bearishness for the market. So I don't want to, anybody who has a different view on this call than what I'm going to offer today, I respect that because that data is out there. What we believe, though, is if you take a more comprehensive look at the economy, a more broad view of the economy, and you look at the resiliency of the consumer, the labor market, corporate earnings, you're going to find collectively more of an economic smile, and that we should be able to continue to grow absent a recession for the foreseeable future. Now, a lot of people believe, and this is one process of thinking that I want to dispel, that because we didn't have a recession in 2023, amidst very high expectations for a recession in 2023, that because we didn't, that we've just kicked the can down the road. And if it didn't happen last year, then it happens this year. And if it doesn't happen this year, then it happens in 2025. And that is not the right way to be thinking about a recession. The reality is, if we were going to have a recession, it probably should have happened last year. We had peak monetary drag, peak fiscal drag. We had the highest movement in interest rates in years, in 30 years. We had this beginnings of geopolitical stress. We had the bottoming of earnings and margins. Like everything did converge that if we were to have a recession, it made sense to have it last year. All of those pressures that we worried about last year are less today. Not more, not less, not pushed into the future. They're less. And so we look at this year, and where last year we thought that there was maybe a 35% chance of a recession, this year we're down to 15% chance of a recession. So we often use the analogy, like I said, kicking the can down the road. I would say we've kicked the can off the road. And that this is an environment where we're probably less likelihood of having a recession today. Now, on the top right chart, I'm going to give you a couple big forecasts of ours, and then we'll start going through the deck to talk about things we worry about, things we don't want you to worry about, and some conditions of the economy. First set of bars, the black bars represent where these numbers ended at the end of 2023, and the blue bars represent where we think these numbers will be at the end of 2024. So firstly, the Fed funds rate. This is monetary policy. We believe, like the market does, that the Fed is done raising interest rates, and they have largely indicated that that's the case. We think in light of recent inflationary trends and communication from the Fed that they will start to lower interest rates in June and that they will cut interest rates 3 times this year, such that we end at 4.6%. Now, I want to be clear. There are views we have that this it's like this is a view we have, but we're not going to die on the hill. Like we know, like data is likely to change. This is one of those views where it's like this is our baseline view, but if inflation moves up or moves down over the next couple months more than expected, this view can change. This is a very fluid expectation right now in the market. On the other hand, the next set of bars, this is a hill we will die on. We believe this is our highest conviction view, which is the market, the economy is going to continue to grow very robustly. Last year, it surprised everybody, growing 3.1%. We think it will grow 2.8% this year. And just to put things in perspective, there is a number we call NAIRU, and NAIRU is the non-accelerating inflation rate of unemployment, but it also is there's a non-inflationary acceleration point of growth, and that optimal level of growth for the economy is about 2.1%. So at 2.1%, we should keep most people employed and keep inflation under control. So we're growing. So 2.1% is Goldilocks, not too hot, not too cold. We are growing faster than that, higher than that. But part of the reason, and a lot of people say, well, if you're growing higher than 2.1%, you're going to have to worry about inflation not improving and still having problems with inflation. One of the reasons we think inflation will continue to be right is this move to 2.8 being a little higher than 2.1. Most of that is coming from immigration that is higher than recent trends. So we're having an influx of legal immigration. I'm not going to talk about illegal immigration, but legal immigration, we're well above trend right now, which is expanding the labor force. And as you expand the labor force, you grow the potential growth, you expand the growth of the economy. And this is the kind of growth that can be non-inflationary. The Federal Reserve will be totally comfortable with 2.8% if it's coming from higher immigration and higher productivity, perhaps from artificial intelligence. So I know 2.8 might feel a little bit high to get our control of inflation, but it's coming from good sources like immigration and productivity growth.
And where were expectations last year, John? Like going into last year,
Oh,
where I
so
mean, I know there were some pretty negative ones out there, but like how much of an upside was it? Just to give people context of how big of a deal last
so
year's growth
yeah,
was.
last year we were an outlier, and we were considered very Pollyanna because we expected the economy to grow 1.1% last year.
So Goldman's perspective was a positive economic growth, positive GDP growth, and at over one. So most people were expecting recession.
The
Zero.
average forecaster last year had a 65, almost 70% chance of recession. So the prevailing view last year was well below 1%, not quite negative growth, but very low growth and the high likelihood of a recession. We were an outlier saying, hold on, we don't think we're going to have a recession. We see too much resilience and too much health in the labor market for that. We think the economy will grow 1.1%.
My
It's,
kids would
it,
my kids would argue it was Taylor Swift's tour that did most of it.
Completely, totally.
Yeah.
Yeah, for sure, Taylor Swift. But the reality is we were both wrong. Nobody fully appreciated how resilient growth was going to be last year. And I think there's still a little element of that today where people and many forecasters think, well, growth will just be slow than the following year. And we're like, no, because the headwinds we had last year aren't around this year. So we feel pretty good about growth. And then on this next set of bars, we think it's the right composition of growth and inflate that allow inflation to continue to move down to 2.2%. Now, we show you an index here called core PCE. This is the Federal Reserve's preferred measure of inflation. So we get CPI and we get these urban numbers and rural numbers, and we get all these different inflation prints. Core PCE is the main number the Fed uses, and they want this number to be on a trajectory to 2%. And we clearly are on that path. Core PCE does a couple interesting things. It removes food and energy, not because we don't buy food and energy, but because it's super volatile and it's mean reverting. So spikes in food prices are often met with, a reduction in food prices. But it also, this inflation measure acts like we do as consumers. So if you go to the grocery store and avocados all of a sudden are super expensive, rather than just assume you buy those avocados anyway, which is what they do in CPI, PCE says, oh, you know what? You rotated into salsa. You did something else. You bought something else because of avocado. So PCE acts a little bit more like we actually do as consumers. In terms of interest rates, we expect the 10-year Treasury, which is at about 4.2% right now. This number 4% is actually, we just adjusted it 3 days ago, is actually going to be 4.25%, so 4.25. So we think interest rates will end the year about where we've started the year. That doesn't mean we don't expect interest rate volatility. Could we see 375 or 475? Yes, we think interest rates will continue to be volatile. The main takeaway, I would say, is that long-term interest rates, we think, are going to be a little stickier and a little higher than we've seen in other cycles. So these high long-term rates are going to stick around for a while, even though the Fed's starting to reduce short-term rates. And then the last view is that the market surprised everybody also with the performance of the stock market, up 26%. We know everybody's heard of the Mag 7, the Magnificent Seven stocks. If you take the Magnificent Seven stocks out of this, the stock market was up 13. So we are definitely in a market that continues to be very dominated by mega cap, profitable, free cash flow generating companies. The market has said, listen, as interest rates have gone up, I'm going to really emphasize profitable companies that can return cash and dividends to me. This year, we expect the market to be up 9%, which means we think the market is already, the market's already done that. So we've pulled those returns forward. Our base case is that we're probably flat for the rest of the year. That doesn't mean we're going to stop moving up and down, but we think 5,200 on the S&P 500 is fairly valued. That being said, and we can unpack this in another point in the call, we do believe that there is a reasonable path to 6,000, another reasonable path to 5,800, and a recessionary path that would take us to 4,500. So there's a lot of directionality that this market could still take. So I don't want you to think that just because we're at our target price for this year that the market is going to just kind of be done. The market never does that, and it's always going to respond to different impulses. And if the market continues to love big cap names and big cap names continue to deliver on earnings, this market's heading higher, notwithstanding what our view is of fair value. Now, these are our views, baseline views. Let me just talk a little bit about things I want you to worry about and things that you don't need to worry about. So we always have a page we call source of volatility. And on this page, we talk a little bit about the yield curve, what we call disinverting. There's a lot of ways we could call it uninverting, disinverting, normalizing, but basically it's the movement where short-term rates come down below long-term rates. And that's the more normal shape of the curve. Historically, that's had some proximity to recessions. So we're going to watch what the yield curve does and see if we get any confirming signals with the disinversion of the curve from the stock market, our stocks down and our credit spreads wider. If I can get confirmation of weaker stocks and wider credit spreads, then this yield curve disinversion might be signaling some weakness. It hasn't yet, but that's something we need to watch. We'll watch manufacturing. As good as the economy has done, manufacturing remains a little bit of an open wound. And if you look at the bottom left chart, our ISM forecast has been, or ISM has been below 50, which is technically in contractionary territory, the third longest time in history. manufacturing is supposed to be a leading economic indicator and tell us about things that are going to happen to the economy in the future. It has not been an accurate leading indicator for at least 2 years now. Really, since COVID, it hasn't been an accurate indicator, but we can't ignore it because history tells us that there's insight that comes from manufacturing. I think the most important thing to keep on our mind is geopolitical risk. There are clearly countries, Russia, China, North Korea, Iran, that are all collectively working against Western interests. They're sharing technology, they're sharing intelligence, they're sharing arms, and that makes a world ripe for mistakes. And as much as I think the market can absorb a lot of these regional conflicts that we're having right now, it's just one mistake, and the U.S. and other countries can get involved relatively quickly, and that will put the market into risk off. And then we always pay attention to valuation. The Magnificent Seven stocks are trading at 32 times earnings. The S&P 500 is trading at 21 times earning. All the good news that I've talked about so far is fully reflected in stocks. And so if there is any disruption to this momentum of good news and stable economic performance, the market has downside to it. So even as we invest, we always worry about, what does my downside risk look like? And I think geopolitical risk is the most likely event that could disrupt the market environment. Right now, things economically and cyclically look pretty good. If I go to the next page, I'll share with you some things that do look pretty good, and I don't want you to worry about. And one of them really is the consumer. If one of the ways we measure, it's a super simple way of thinking about it. One of the ways we measure the consumer is in what we call the misery index. And the misery index on this top left is just two things. It is the unemployment rate. Do I have a job? And secondly, the inflation rate. Can I afford to pay for things? So do I have a job? Can I pay for things? That's basically the visceral consumer existence. And when we look at the misery index, it is worse 83% of the time. So even though consumer sentiment is not that great, the actual underlying conditions of the economy are really not that bad. And overwhelmingly, they're worse, 4 out of 5 times than where they are today. Household wealth is in the 96th percentile. So there's more accumulated wealth. And frankly, there's $26 trillion of untapped home equity. So for many of us, our largest investment, our largest asset, our home, is in great shape. The market is massively undersupplied versus demographic needs. And so the crisis in housing is not one of speculation, it's one of affordability. It's a problem for first-time home buyers. It's a problem that many homeowners who want to upgrade their home are handcuffed by their attractive mortgage that they currently have. So there's a lack of affordability in housing, but there's a lot of untapped wealth also across this economy.
Two
We have
questions.
a labor market. Oh, go ahead. Sorry,
Yeah,
Kyle.
you're good. You're good. You're good. You told me you get on a roll, and you're on one, so I'm
Okay.
gonna interject.
The labor
So there's
market, the
you.
labor market is again really healthy. 2 years of an unemployment rate below 4%. It's not science here, but it's really hard to have a recession when 96% of your population has a job.
Yeah, and I think there's a couple questions here I want to interject if that's okay with you for a moment here.
Yeah.
So there's been a lot of discussion around, I get personally nervous when I hear things like new normal. I think we both were in this world during the dot-com bust, and they started valuing companies on a price to sales ratio as the new normal, right?
Yeah.
I take you back a little there. But there's been a lot of conversation around labor supply shortages, housing. We have, it's a supply side versus demand side of driving housing prices. That reality that under current economic conditions is a 3% inflation rate, kind of the new normal versus the 2.5 the Fed has wanted to peg inflation at. Are you hearing any conversation, or is there any thoughts in around the Fed being more comfortable with a slightly higher, ongoing rate of inflation due to labor shortages, supply shortages, and things that seem to be kind of persistent components of our economy on it going forward?
Yeah, it's. I think it's a really thoughtful question, Kyle. All we can do is take the Fed has been asked that specific question, which is 2% a realistic inflation rate going forward? And the Fed has said, absolutely. We are locked in on a 2% inflation rate. We know that there are these structural problems we have in shelter and in wages that could keep it, the last mile of getting inflation from, 3 to 2 might take longer than prior cycles because of these challenges, but they absolutely believe that 2% is the right number. In fact, if you look at corporate America right now, and I don't mean to agitate people,
That's
but
okay.
corporate America is too darn profitable right now. And what we're seeing is that corporate America, certain sectors of corporate America, particularly in services, are charging higher prices because they can, and their input costs have come down, but they haven't lowered their price to be commensurate with the decline. And so corporate America is far too profitable. And one of the reasons we see inflation moving a little bit lower is whether it's a consumer revolt or competition coming in, we think you're going to start to see lower prices as that excess margin that corporations have been charging is unsustainable. But right now, as a population, we've just gotten a little too comfortable paying the prices that we have. I mean, you go out to fast casual today and you're like, well, that escalated quickly.
I got 4 kids, John.
Yeah,
I gotta bring a Benjamin for me to do some of that stuff. It's crazy.
completely.
Yeah.
There's not a time that we do not. By the way, this is an important lead into another point,
Yes.
which is if I go to the next slide. By the way, I don't want to cut you off. If you have another
No,
question,
no, no. I think, and one of the things I think you made mention of, and it's one of those things that gets a lot of press, but it's inaccurate. Talk to me a little bit about the labor force participation rate, because there's a concept that's misperceived about it, and I want to get your. One of the things we hear a lot is, well, we just need to get people back to work, right? But
yeah,
the data suggests something different, at least from what I've seen.
I
Um,
mean, immigration is offsetting a good chunk of that. The reality is the bulk of labor has completely returned. The data is very clear on this topic, that your 25 to 54-year-old cohort, kind of the real middle of the labor force, is all back. Like all of those disincentives to stay on the sidelines that we saw during COVID, that's all been exhausted. Anybody who wants a job has been able to find a job. The challenge we have in the participation rate has been with the 55 and older group, which is many of them retired earlier, 3 to 5 years before they planned on retiring, and they're not coming back. And as long as the stock market remains healthy and their 401ks are all in good shape, they're not coming back. Or if they do come back, they come back in a very expensive way, like full benefits, but only 3 days a week. And so the only kind of like remaining issue, and I don't think it's going to be resolved, is this early retirement of the 55 and olders. And I think they're gone. I don't think they're coming back. And so that's a lot of institutional knowledge and experience that we have lost. And it might take a few years to catch up with that. But I think that part of participation is probably they're not coming back.
Yeah, when I've seen the data in that more younger age group and how many of them working, and I take my family's example, I use a lot. My wife, has 4 children she's, responsible for, which is, one shy of a basketball team. We're thankful that she doesn't have to leave the home to earn an income, right? It would take something pretty
Yeah,
meaningful for me to want her to step back into the workforce despite her tremendous talents. And so, she gets encapsulated in that she would fit into that data point of in that age group but not working, right? That number never hits 100%.
yeah,
So I appreciate you shedding some light on that, because I think that's there's some perception, hey, the 30 it's whoever's speaking it, right? Those are 30 years and under need to get out of their parents' basement, go get a job. And the data just really doesn't point to that being the actual issue anymore, that those who are able to get a job, are currently working. And
Yeah.
it's an interesting element. So thanks for expanding on
Yeah. I think that's very much the case. I cannot believe we've actually been going a half an hour already. So let me hit a couple other things. This to me is a very interesting page, and then after we do this, I'll do some economic forecasts, and then we'll go into the election stuff. Um, I imagine most people on this call believe the stock market has been volatile, and I'm going to tell you it has not. It has been pessimistic. It hasn't been volatile, it's been pessimistic. If you look at the bottom table here, I show you there's basically 250 trading days a year. And of those 250 trading days, on average, 62 of them will have a 1% move up or down. 17 will have a 2% move up or down. 7 will be a 3% move up and down, and so on and so forth. That's a typical year. Now, 2022, where nothing worked, was an incredibly volatile year. And I think when you think that the markets are volatile, it's a bit of an echo from 2022. But if you look at 2023, last year, the market had 64 days that it was up or down 1%, right on top of long term average. Only 2 days that the market moved more than 2%, and 0, 3, 4s, and 5s. This market has not had any sell offs. It has not had any major rallies. This is a market that, if you're waiting for a pullback, has not given you any pullbacks. And these are difficult markets if you try and wait them out. You always feel like you're buying a little bit expensive, but the markets have not been volatile. What they have been is a little bit pessimistic. And I want to unpack this chart here on the top. This is important. We have this has happened about 3 other times where data is going in different directions. The data I'm talking about is economic data, measures of the health of the economy. And in this example, we have what we call the current activity indicator. It's CAI. It's basically the 40 most useful economic inputs to the economy. So it's our collection of the 40 data points that we think tell us the most about the health of the economy. When we look at that economic data, it breaks down into 2 camps: hard data and soft data. The hard data, the blue bars here, it's the easy to measure stuff. It's not debatable. It's the number of jobs, the number of cars, the number of homes, the number of permits, the number of widgets. It is the physical activity of an economy. Easy to measure, easy to observe. And as much as we have worried about a recession over the last 2 years, if I look at these blue bars, they're, except for 1 month, they're all convincingly positive. It feels almost a little bit like Y2K. For those of us old enough to remember Y2K, there was this huge worry we had about the year 2000, and that the digital systems were not going to be able to deal with the conversion to 2001. We didn't have the digits in the code. And so we worried for 2 to 3 years about Y2K, and it ended up being the greatest non-event in human history. If you look at the hard data, if you look at these blue bars, as much consternation as we have given a recession, it's not in the data. Now, I'm about to say but if you look at the soft data, the dark green, dark bars here, you see a different story. Now, what is soft data? Soft data is sentiment. It is feelings. It is a survey that you're called and they ask you, do you think this is a good time to buy a car? Do you think you have good job security? Will it be better a year from now? It is a subjective assessment of the state of the economy by both consumers, individuals, and companies. ISM is a manufacturing soft data point. And so what we have is this interesting, historically rare anomaly that even though the economy physically is doing very well, The sentiment side of the economy has been very, very weak. So we know things are fine, but we feel bad about it. And this is a chronic condition going on in the economy today. Now, I'm going to give you three reasons, and I need everybody to not get all fired up by these reasons. But there's three reasons that sentiment has been poor. One is inflation. The most important one by a mile is there is an echo with inflation. And just like we were talking about going out to mills, even though inflation is slowing down to the 2% range, it's 2% on top of the 9% we had last year. And so every time you eat or get gas or buy anything, you're feeling that pressure. And so there's a lag, there's a sentiment lag that comes from inflation that we don't experience everything else. So there's a frustration and a pessimism, first and foremost, from going through a hyperinflation period, number one. Number two, there's a political reason behind this. And the political reason is that the single highest factor that Republicans vote and poll on is the economy. Democrats they care about the economy, but they have higher issues that spike up on them. So when you survey conservatives right now or Republicans, you find an issue that happens, and this is relatively predictable, which is if there's a Democrat in the White House, they don't like the economy, even if it's doing fine. If there's a Republican in the White House, you could be in the depths of a recession, and Republicans will basically be comfortable with the economy. And again, that is the nuance of the highest factor for Republicans. Now, again, Democrats, it's a different issue that would swing. But the thing is economic issues show up in soft data. Social issues do not. So the current political climate creates this pessimism about the state of the economy. And then the last issue is it's really hard to survey people today, politically or economically. Everyone has a cell phone. No one picks it up if you have an unknown number. And think about it. If someone called you and the number it said the U.S. Department of Labor and Statistics, you're not taking that call either. And so it's become very difficult versus 40, 50 years ago when we all just had a landline in a house, no caller ID. It's become really difficult to get really good polling, really good surveys. And there's a bias to it. There's a bias in economic surveys. There's a bias in political surveys. And so we think, and we are overstating right now the degree of pessimism, the weakness of soft data. And so we encourage investors to really focus on the blue bars. That to us is the more accurate visual. So the blue bars show us the Mona Lisa smile. But if you want to find the Mona Lisa frown, all you got to do is look for the soft data, and it's there.
Interesting.
Okay, we got it. We got to wrap up and do a time for questions. Let me go. I'm going to go to the very end here.
I've been fielding questions that come in, John, so we're doing okay there. So, like some of the questions you've been asking are ones that have been, I've been grabbing and asking.
Okay, all right. So we'll just talk about high level elections. It's the first thing I'll say is I don't know. I don't know how things are going to play out. But we've got really thin leadership margin for Republicans in the House. It's very likely that wherever the momentum is in the White House, because fewer and fewer voters are voting split tickets down ballot, whatever the outcome is for the White House will probably be reflected in the House of Representatives. The Senate, on the other hand, has just an incredibly favorable calendar for Republicans. There are 34 seats up for re-election in the Senate. 24 of those Senate seats are held by Democrats or independents that caucus with Democrats. And of those 24, 8 are considered very, very vulnerable and competitive seats. One of those 8 is almost assuredly the Joe Manchin retirement seat in West Virginia. Is almost assuredly going to go to the Republican Party. So that right there would create a 50-50 Senate with 7 seven competitive Democratic seats in play still to go. And so, unless the Republicans can figure out a way to mess up the election, they should be able to take the Senate. So, baseline is that there's probably, in our view, about a 50% chance of a Republican sweep, and a 50% chance of a split Congress, with the one thing we believe would be the Republicans taking the Senate. We see very limited scope for a Democratic sweep just because of the composition of the Senate. So the big one we're all thinking about is obviously the general election for the president. Obviously, we know the two major contenders. I know that Kennedy is, as the independent candidate, is going to. I'm not prepared to really talk about the impact of the independent candidate. I think the prevailing wisdom is that kind of siphons off the Democratic Party. But at the end of the day, with a huge portion of the Republican Party that are, not convinced of voting for Trump, we don't quite know how the independent candidate will play. But the basic math is as follows. We have a general election. The goal is to get to 270 electoral votes. We know that there are clearly very defined red states, very defined blue states, and then some competitive toss-up states that we'll talk about. If we think about just looking back at 2020, there are 184 solid blue states that aren't even up for negotiation. California will vote for the Democratic candidate. That's going to happen. The state where I live, Utah, is assuredly going to be voting for the Republican candidate. There are 42 states like Colorado, New Mexico that are likely to go Democrat. That gets the Democratic Party on Tuesday night before the election even happens to 226. You could give them the three states that President Biden won by 1%, and that would include Michigan, Nevada, and Pennsylvania, and that would put the Democrats at 266 on the way to 270. Now, again, based on current polling, can we really give Michigan and Nevada and Pennsylvania to the Democrats? That's super debatable. So this is just to put things in a little bit of context. I'm not saying this is how it's going to play out. Republicans, 172 solid red, 47 states. This would mostly be Florida and Ohio that lean Republican, likely go Republican. We would expect the Republicans to probably pick up North Carolina. So at the start of the race to 270, it's going to be 266 versus 235. What's left? And the answer is Arizona, Georgia, and Wisconsin. If President Biden wins one of those three, he's in. President Trump would have to do a clean sweep on those three. And so it's going to end up coming down to probably even though the total vote will be millions and millions difference between the candidates, the electoral vote may come down to 50 or 60,000 independent voters in those three states. So it's going to end up being incredibly close. I can't even pretend to know how this is going to come out. But I want to get to this point. How much should you care? Now, that's a loaded question. Okay? Because
talking about money here, John. That's it. That's the only thing we're here.
So let's just the answer is politically, socially, culturally, whatever. You should care a ton. This is huge. But from an investment standpoint, I'm going to tell you that I don't think those concerns, those political views you have should be reflected in your portfolio. So let's just do that. And by the way, what I'm going to do right now over the next 60 seconds is waste your time. Okay, chart on the left. Going back to 1930, how did the stock market do with a Republican in the White House? 11%. Believe it or not, the stock market has done a little bit better with a Democrat in the White House. If I change the dates and go to instead just 1950 or 1980, totally different numbers. So take this with a grain of salt. The Senate has been the markets have done convincingly better when the Republicans control the Senate. And the House is a little bit of a toss-up. between, it's 12 versus 13%, Democrats versus Republicans in terms of control. Now, for those who remember their statistics in college, the table on the right tells me how reliable are these statistics I just showed you. How meaningful is this chart on the left? And what the data says is the relationship between an election and a market outcome is non-existent. So do the markets really care which party is president? Is there a predictable relationship there? And the answer is not at all. Virtually zero R squared, T statistics, P values, any measure of statistical reliability and significance is non-existent, meaning that it's mostly coincidental and the markets absolutely trade on a broader set of inputs, economic inputs, earnings inputs. Does the market care about the Senate? Not really. The House? Not really. The year of the president? Not really. And I shouldn't use the word care. What I should say is, can you reliably invest on an elected outcome? And the answer is you can't. Now, this is nuanced. This election will matter. A Republican sweep means that the tax plan that expires in 2025, the Trump tax breaks that expire in 2025, a Republican sweep will look much different legislatively than a divided government sweep. So I'm not going to pretend that elections don't matter. I'm going to tell you that they're not investable. And when it comes to legislative risk and legislative change that comes and is born out of elections, you address that with working with Kyle on asset location, on the structure of your portfolio, the timing of maybe capital gains. It is about execution at the individual portfolio level and portfolio design. It's not about being in or out of the market or living in the US or moving to Canada. There's no data about the latter, but there's plenty of evidence to suggest that it is a more hands-on approach working with your financial professional. That's how you manage legislative risk. So that would be the main takeaway. I'm going to pause there, see if we can take any questions. I see there's a bunch in the queue, but
Yeah,
again,
so the only one that's left that we haven't, I think you answered the election question we had. The only one that's remaining is you mentioned you think the 10 year is going to finish about the same place it did beginning of the year, plus or minus small, but the Fed's going to cut rates this
yeah.
year. Like talk to the folks who are thinking about buying a home or refinancing or whatever. Which one of those is going to affect mortgage rates? Do you see mortgage rates coming down this year? Which one of those drives that for our
Yeah, so mortgage rates are going to be mostly impacted by the 10-year treasury rather than the Fed. So it will provide a little bit of relief maybe on some of the variable rate, floating rate structures in mortgages, but only incrementally. I think, we don't have a 10-year mortgage forecast, but we would probably expect on a 30-year fixed a mid-six number to be a reasonable number. The spread between mortgage rates and 10-year treasury is a little wide right now. That should narrow. So even though we don't see mortgage long-term rates coming down much this year, there's probably a little more cushion or opportunity for mortgage rates to come down a little bit more than the 10-year treasury. But at the end of the day, most of what's happening with mortgage rates is going to happen with the long end of the bond market, these longer maturities. So unfortunately, I wouldn't see much reprieve with mortgage rates. I think what we're ultimately going to see is at some point, homeowners are going to basically realize that maybe a high five to low six handle on a mortgage is the new normal.
Awesome. I will let you know that we did get one vote for you and I on an independent ticket for president and vice president. They'd indicate who's going to be in which position, but apparently we delivered some great value today, John. So, in case this thing at Goldman Sachs doesn't work out for you, apparently we've got a new gig opening for us. So that's good news to hear.
I'll
So
be happy to be your running mate, Kyle.
I of opportunities in my life I have very limited interest in. We're just having this discussion of just how much the respect for the role of president has evolved in decades in the last 100 years. And some of the I think sometimes we take a pause and understand who has been our president and in history at a broader scale. it begins to put into context that we've had some interesting characters in that position over the years. I'm not interested in being one of them.
Yeah.
Um, so, John, thank you again. Charlie, thank you again for arranging this time. Thank you to everyone who joined this. I really appreciate the questions that you asked, some really thoughtful ones, and thanks for letting me to fill those in. If you watch this presentation, you have any additional questions, Charlie and John are resources to me. I have the pleasure of connecting with Charlie quite often, and he brings individuals like John to me when I have questions for the folks at John's level as well. So if you didn't get your question answered today, feel comfortable sending me an email, shooting me that message. We'll get those into their team on a post-event basis. Most importantly, I just want to take a minute and pause and thank each and every one of you, whether you're on this live or afterwards, for your trust and continue partnership over the last almost 22 years as being an advisor. Without that, I don't get to have these conversations. When I was in college, I loved to call folks at Goldman, believe it or not, and have conversations with them. I've always loved this part of it. And so if it wasn't for your partnership, I don't get to hang out with folks like John, who I truly enjoy their wisdom and insight. I appreciate your trust. I know it's an interesting year, right? We all have a vested interest in who becomes president. We passionately care about our person and our peace. But I think the most important thing I took away from this is the data just simply says that we could sit back and relax, make the choice that feels authentic for us, our families, our values, and our vision, and our what we see for our country, and know that our investments will take care of themselves if we've managed and positioned them properly. John, I thank you for your time. Charlie, thank you for investing with us. And I certainly hope to see everyone soon here at our office.